Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience and listeners, this is James Kandasamy from Achieve Wealth Podcast, where we focus a lot on value-add commercial real estate investing. And we usually talk to commercial real estate operators who has been very active buying deals nowadays. Today I have Brian Murray. So if you have not heard about Brian Murray, he's the author of the best-selling and award-winning book, Crushing It in Apartments and Commercial Real Estate. And he owns almost 700 units right now on his own. And I think out of 700, 600 of it is apartments and 100 units is on the office side. So, hey, Brian, welcome to the show.
I'm really happy to be here, James. Thanks for having me.
Really happy to have you here. So tell me about how did you go from 0 to 600 multifamily, 0 to 700 all asset classes on your own without syndication?
Yeah, well, I started 12 years ago and I'm located in upstate New York. That's quite a bit different of a market than New York City. But, my first property was an office building, and it was a distressed office building. And, from that very first deal, I did a lot of value add and frankly, I really didn't know what I was doing. I was kind of figuring stuff out as I went along. And, but I progressively made that property perform better over a couple of years and added a ton of value. And, on that deal, I assumed the mortgage, and on my second deal, I did an owner finance situation. It was another property that was half full. I filled it up and refinanced out of both of those and bought 3 more properties and followed that path the entire way, which is find well-located properties that were not well managed or had some other large value add component. Exercise that value add, and then refinance, take cash out, and buy more properties. And that's the exact path that I followed to get to where I'm at today.
That's crazy, right? So, which is good. I mean, that's the model that, it's an absolute value add model, which is basically the theme of this podcast. And so did you buy and then improve it and then refinance the money out, or did you sell it? And I didn't get that part. Can you clarify that?
Yeah, so refinance the money out. I am primarily buy and hold still to this day, but especially in the first 10 years. I think I sold one or two properties, smaller properties for the most part during that time. And I am selling some of my smaller properties right now to redeploy those funds into larger properties. But my strategy has really been buy and hold.
Awesome. So before we go further, I want to clarify about your book, right? Crushing It. I mean, I remember asking this question to you when we met face to face. So did Gary V take the Crushing It name from you, or you took it from him? Which one is that?
So his book Crushing It came out about a year after mine.
Oh, okay.
But he launched a book called Crush It prior to when mine came out. But he took the Crushing It, and that's fine. It doesn't matter. It's all good. So
well, it must be a good name because both of you are like bestseller, in your own domain, right? So awesome.
There you go.
Correct. So right now, what's your plan? You own this many units on your own, and what's your plan right now?
So right now, I'm really focused on diversifying, and I was really excited to do my first mastermind, which was last year, which is how you and I met, and I met some great people at that mastermind, and I highly recommend that to other people, to surround yourself with other folks that are doing what you're doing. But when I went off to this mastermind, it was really eye-opening for me because pretty much everybody there was doing syndication, and it was a model that was really new for me. And I just learned a ton about what people were doing. And my model has worked great for me up to this point, but I've reached a size where growing purely organically is becoming more challenging to maintain that pace of growth. I think also with valuations at a higher point, it's more and more challenging each year to pull that much value add out with refis. So and I think another factor that's come into play is I've been very, very dedicated to putting every dollar that I've earned back into my real estate. I mean, that's been a big part of how I've done what I've done, is to continuously reinvest back in. As a result of that, to this point, I've lived fairly frugally, and at a certain point, you want to not have to put every dollar back in, but to maintain that growth rate, I've got to look at other options. I also want to diversify geographically, because most of my properties are in one location. And so I'm in the middle of my first syndication right now. And I've met so many good people that now I'm developing partners and looking at new markets. And it's very exciting for me. I love to learn. I love to try new things, and getting into these other markets, and meeting accomplished people like yourself. It's very motivating. And so I'm just super excited about it.
Yeah, it's eye opening when you go and talk to different people, who's doing at the same level as you, or doing much more higher level, right? Because you can see a different thought process and how people do things, right? So
yeah.
And why are you moving towards syndication? I mean, you own so many units on your own. Can you go into a bit more detail on why do you think syndication is going to be beneficial for you right now in this market cycle as well, or in your investment cycle?
Well, syndication, it does open up a lot more opportunities in terms of size. So, okay. For example, right now I'm looking very closely at an apartment complex that's approximately 300 units. It's in a market that's new for me, that I've been doing a lot of research on, and that would be a real challenge to try to pull off on my own. It really wouldn't be possible right now. So the largest property that I've purchased strictly on my own without raising any outside money, I did last year. It was 126 units, and to try to purchase something that's 300 plus units would be that wouldn't be possible for me right now. So it's pretty exciting. And I think another thing is I really enjoy working with the idea of doing some projects with partners, and getting into some of these new markets. So there's another piece of it too that's kind of exciting. Is I've reached a point where I've done pretty well for myself, and the idea of helping other investors who want to put their money to work to achieve their goals. I think that's going to be rewarding too. That if a project does really well, that there's it's all those limited partners that come in that can then improve their lives through their investment as well. And if I can be a part of that, I think I'll find that very rewarding.
Okay, that's awesome. So scalability is important, and you think of helping others as well to make money, right? Especially I think other investors or other GPs who need your skills, I would say, right? So
yeah, absolutely. Yeah, and that's one of the things that's great too, is I've found that's meeting these other people that are doing it, is I've got a different experience. So just like I'm learning from people like you, I'm finding that partners, I can bring some different perspectives and value to the table as well. So you always want to partner with people that have strengths in an area that are different from you. And that's what makes a strong team.
Yeah, absolutely. Especially in commercial real estate, right? Because the number of knobs that you can you can tune, right? It's so many knobs, right?
Yeah.
And especially like in multifamily, because it's very, very management intensive compared to the triple net, other commercial properties, right? Multifamily is a lot of management incentive intensive, and it gives a lot of ways to make more money or to scale down or to scale up, even though you have to be really, really skilled at that, but it just gives you a lot more opportunity, right? And the lease is 1 year term or 6 months term. You can quickly raise or reduce rents. It gives you a lot more fungibility, I would say, right? So and what I mean, you have like as we talked in the beginning, you have like 600 units multifamily and 100 office spaces, right? So can we go a bit more detail into the office? What kind of office is it, and how did you strategically balance between the 600 and 100 office? Is it opportunistically, or what did you see and why did you do it?
So I started off with the office, and actually my second property was retail. And so starting on that commercial side was really interesting. I think one of the things it did for me is really emphasize my focus on customer service and customer care with tenants. And when I tried my first multifamily, I think that there were differences, but there were also a lot of similarities. Mm-hmm. So the value add approach that I was taking to office or retail worked just as well with multifamily, and our focus on really taking care of our tenants as our customers really served us really well in that area also. Over time, as recently as say 2 or 3 years ago, we had reached a point where, up to that point, we had been more office and retail. And then about 2 years ago, I would say we were 50-50. And now we're closer to 2/3, maybe even 70% multifamily, with the rest commercial in terms of the makeup of our portfolio. So as time went by, we've really gravitated toward multifamily, and that's our 100% focus right now. I think the biggest thing is that there's a number of things we like about multifamily. From our experience with commercial, you've always got a little bit more risk because you tend to have, not always, but you often will have tenants that comprise a disproportionately large percentage of your income. And that can leave you really vulnerable if somebody leaves. So on more than one occasion, we've had a commercial property where someone that takes up more than half of the space in that property leaves unexpectedly. And then you've got, with one tenant leaving, you have a property that is negative cash flow. And if you don't have a portfolio in place to support that, that can be devastating. And it's really not fun, even if you have a portfolio to perform it. And then when you go to backfill that space, it's more challenging in commercial properties, because you oftentimes have to find the exact right tenant for that space, for that location, for the tenant mix in the property, for the configuration of the floor plan. There's a lot of things that, different commercial looking for. If you just adjust the rents up and down, or maybe offer some concessions, a lot of times the market doesn't immediately react to that, right? So turning that dial like you do in multifamily, you have less control, right? So if you're looking for a particular type of commercial tenant, it's not unusual for us to sit on a vacant space for 1, 2, or more years before the right tenant comes along and fits in and takes that space. With multifamily, you've got those dials that you can turn and say, hey, we're gonna run a special. We're going to bump rents. We're going to drop rents. And you usually will see a pretty quick reaction from the market to the changes that you make. And that is, from my perspective, that's better. You always want to have more control and the ability to adjust with your market, adjust, to combat your competition and different things like that. So, and frankly, we've enjoyed working with the tenants. I think there's a perception out there that a lot of people would love to invest in commercial because they think they have this idea that working with white collar tenants would be much better, wouldn't have the problems. But in our experience, they can be more challenging. They can be more demanding, and it's sometimes even unreasonable with what they're looking for. And you don't usually find that as much with the residential tenants in multifamily. We do primarily workforce housing, and the people that we deal with they tend to be good, down to earth people and reasonable. So we appreciate that.
And when you talk about office, this is the normal office tenants, I guess, right?
Yeah, a full spectrum, mostly professional tenants. Okay. We have we've got plenty of medical tenants. We have lawyers, accountants, all types of. We've got not-for-profit offices, engineers and architects. Pretty much any type of white-collar professionals.
Got it. That's very interesting. So when was the aha moment that, hey, I should do multifamily? At what point? Because you were focus a lot on office, right? What was that triggering moment where you said, okay, I may need to look at this multifamily?
Well, I don't know if there was a specific moment. I think it happened gradually over time. And when we had about 50-50 multifamily and commercial, I think one of the big things was watching the performance of the two halves of the portfolio and seeing which half was performing better. And, part of it had to do with the types of value add projects we were finding. And I thought we were better able to execute on the value adds on the multifamily side. And that portion of our portfolio just kept outperforming the commercial side. And I just saw in the market that we're in, I just saw more opportunity there, and I felt like it was a more stable income base. So, I think it just happened gradually over time, and you kind of tend to, slowly move in the direction that's performing well and where the needs are in your marketplace.
Got it. So all the deals that you have done on multifamily, right? So how did you choose? All these deals are in upstate New York, is that right?
Yes. Yeah.
Okay, so you may not choose the city because that's where you live, I guess, right? The area, yeah. Right? But how did you select the submarket? Okay, this deal is good in this submarket. What are the parameters that you looked at when you look at a deal in multifamily?
So, we have a really close familiarity with the subtleties of the market, and so it's fairly nuanced. Like there's not one overarching thing. One of the primary drivers of the market where we are is not that far away, is a fairly large military base. Mm-hmm. And so one of the factors that we look at is, while we definitely welcome military tenants, we have shied away from the properties that are closer to the military base and tend to have a really high percentage of military population. And that's just because there's so much turnover. Lenders are less excited about lending to those properties because they know that long term, there could be downsizing, a base could close, there's exposure with that. So we have gravitated within our region to the areas that are maybe a combination. We'll have some military, but not be all military, and into the communities where people want to live, and the parts of the city that we feel are strong, and good, safe locations and convenient locations for the major employers in the area.
Got it. And on average, right now, what is the price per door in that market? Because I never talked to anybody from New York who's buying multifamily. You are upstate New York, not in the New York City, but in general, can you give us some guideline on price per door, or what cap rate that stabilized deals are being bought right now?
Yes, absolutely. So it's a really, really wide range. So that's what I would say at first. The most recent stabilized property that we purchased, we paid about $60,000 a door. There are properties selling in the area, $80,000 plus per door. Not that often, but a lot of the properties we've purchased a couple of decent sized properties at auction. We've purchased a lot of distressed properties. The 126 unit that we purchased last year, we paid in the 40s per door. And that's pretty low for this area, actually. But the occupancy was below 60% when we bought it, and it had a lot of deferred maintenance. So, I do feel like we got a fair deal and a good deal on that because there was so much upside. But, there was a reason that it was priced that low. And so you can come along properties in this area that have low price points, sometimes even down into the 30s per door. But they are usually, there's a reason why they might be in severe distress. And, but for stabilized properties, I think you're mostly looking at maybe 50 to 70 a door.
Okay. And you also mentioned that you're looking at other markets now, right? And
yes.
Why is that? And what's your criteria to look for other markets?
So the number one reason is really a risk management type of approach where, anybody who's come in and taken a close look at our business, and in one point, even a few years back, I had some graduate students come in and they analyzed it, and everybody said, "Hey, you're kind of crazy. You've got all your properties are concentrated right here in this one city, and within now they're all within maybe half an hour drive of that city." And there's a lot of risk involved to that, right? So if that city that I focused on starts to decline, or say that military base that's not that far away, if they downsize, and then that all affects my portfolio. And so I've known for a long time that it would be wise to diversify geographically, and it's time to do that. Another factor is, frankly, this is not a huge city. It's not a big area that I'm in. And, we've got limited opportunities for growth here. There's a limited number of properties that come onto the market. And realistically, it's time for us to look to other places. So, it's a variety of things.
So when you're looking at, so now can you, let's say you're looking at a new city, right? Like a city A and city B. Yep. What do you look for in that city that you think is going to be appealing to you?
Well, I think there's a variety of different factors. Probably the number one thing that makes a city appealing is job growth. Job creation. Being located in upstate New York, there's really, it's not a strong area for job growth. There's pros and cons to being in a market that's undesirable, right? So I have less competition. I can buy things at much higher cap rates, and I can get properties to cash flow better if I have less competition and higher cap rates. So, there's sometimes you can look at it and say, hey, if you're in a market that's less desirable, sometimes you're getting properties at a great deal, and there's something to be said for that. But as I look to new markets, and I'm trying to find something where cap rates haven't dropped too far, and that you can get a reasonable return, but that you've got that benefit of a healthy growth in population and jobs. But I think because I'm looking for geographic diversity, I'm looking for a market that's going to show more stability. It's on an uptrend, and I just like any other place, no matter what market I'm looking at, I've realized over time just how critical the specific location with any city is. So almost any city, has their good parts and their bad parts. And, so you could take any market that you choose and break it down into all different, more and less appealing locations. And so I wouldn't just throw and say, hey, this one city is great, even though the population is growing. And you and I talked about a property not that long ago that you were familiar with the location, and you very wisely were like, oh, that's not the right. It might be a good city, but that's not the right part of the city.
Correct.
So
you are sitting in upstate New York. You looked at the entire nation. Can you give us, top 3 cities that you think that you want to be involved in, that you think has a strong growth story?
Well, that's kind of it's a work in progress for sure. And what I would say is that sort of the candidates that I've narrowed it down to, the commonality would be, they tend to be the places that people are migrating to. And being in upstate New York, where a lot of people are leaving the area, I want to look toward the places they're going. And So primarily in the Southeast, pretty much our candidates are everything from, starting in probably North Carolina, going down to Florida, and, all the way over to maybe a little bit in Texas. But I think, Georgia is an interesting market that a lot of people are pursuing. I'm partnering on a project in Kentucky right now, and we're looking at North Carolina, and there's some very attractive markets in Florida as well.
Got it. So let's before I want to go into the deal level analysis that you do, I want to quickly ask this question, because it's very unique to you, because you had your own deals and now you're going into syndication, right? So what do you think the skills needed from yourself, right, when you are having your own deals, right, where you can skip a distribution, or whatever happened to the deal is your own problem, right? Nobody knows about it. Right. That's right. So now you're going into syndication, right, where it involves a lot more people. What do you think is a few skills that a syndicator needs that need to be successful in syndication?
Sure. I mean, I would say start with one of the big ones, which is something that I don't have, which is an investor base, and that's a whole job unto itself. And over the years, doing what I've been doing and getting some acknowledgments for that, I had a lot of people approach me over the years and say, "Hey, can I invest?" And I never, took them up on that, and now I'm doing that. But what I've realized is, in getting to know all these folks that are out there, that there's a lot of people who are interested in partnering with me who already have those investor bases and have that skill set of managing those investors and taking care of all aspects of that. So at this point, I'm primarily thinking that I bring more value in the weighing in on the underwriting and the property and identifying all the value add opportunities and making sure that people look at it as more than a spreadsheet, because there's so much more. And I toured a property last week and was able to uncover quite a few things. The broker that was there, I was one of the last people. They'd had about 40 tours, and I came through and identified some significant value add opportunities that the broker said no one else picked up on. Mm-hmm. And I think that's something I didn't discuss, but we've managed all of our own properties that whole time, and so the knowledge that you get from that just brings so much better of analysis to a deal to make sure you're vetting it properly, you're not overpaying, you're also not underpaying, and that there might be value there that you're not realizing, that some of the assumptions that you're making for rent growth are real and can actually be feasible for implementation. And so, those are some of the things that I bring, and the experience and having the portfolio I have gives lenders a lot of comfort. And so I'm recognizing that, hey, I could focus on my strengths and bring some things to a partnership and take those areas that I don't have and other people might and partner up. So, if someone's going to do it on their own, they've got to have a pretty broad skill set. And that's a challenge, to have the operational knowledge and that bring that side, and also have the people skills and the investor relationships. It's not easy. I have a lot of respect for people that are doing it all.
Absolutely. So you are a true operator, where you underwrite deals, you understand the operation, and you are doing your own asset management, and you are missing the investor base creation side of it, which I think you are.
That's right.
Either partnering or slowly building that up. So which is awesome. For me, it's the operators are the top of the food chain, right? Because they are the backbone of the whole deal. They know what's happening in terms of the rents, how many % of rents increase is happening on each unit, how many units are being turned, what is the make ready period, what is the delinquency, what is the idling unit period. There's a lot of parameters in the multifamily operation, which can be optimized, right? And if you know that very well, your underwriting can be very, very solid, I would say.
Right. And I think you also bring a reality check. Mm-hmm. I think that the folks that are operating in the syndication space that don't have as much operating experience, it's easy to look at numbers and assumptions in a spreadsheet, and it's challenging to actually recognize what that means in terms of the actual human beings who are there living in the apartments, what it means for the contractors and the property managers, and whether what you're assuming is even practical or could even, I look at a spreadsheet and, I'm looking at them realizing, hey, I looked at one today and I told somebody, I'm like, do you understand how much drama will be involved in this? And so if you haven't done that, you don't know. And sometimes that translates into, you might need to maybe tone back your rent growth, or you might need to say, hey, maybe we implement something like this over time so that we don't have an all out rebellion on our hands.
Yeah.
So, it's a challenge to bring all those things to the table.
Yeah, I've seen people who come to me, first few deals and say, oh, this is all bills paid. I'm just going to change it to tenant paid bills. I said, wow, that's easy, right? Yeah, we can see the value, right? Well, you do not know how much drama you're going to have there, right? And you might not be able to do that on a specific property or specific location, right? So, and they say they want to do the utility bill back. They want to increase the rent. They want to charge covered parking. They want to do, laundry increase. Yeah. So many things they want to do at the same time. And I can tell you they don't have the experience actually. But the thing is, a lot of people have been making money, right? Even without all the skills, right? And I always tell, everybody's a champ in a bull market.
Exactly. Yeah. But rising tide lifts all ships, right?
Yeah, correct. So, people may not look at that skill more in detail or give due consideration to that type of skills where, the operation is important. But I think it's important if you want to sustain good rent growth across different market cycles. So coming back to underwriting, right? So right now you're looking at deals. How many % of deals do you reject immediately by just looking at it?
Wow, I would say well over 90%.
Okay, so the 10% that you have, what do you look for in that 10%? What do you do? What are the steps that you take to look at that 10%?
I think the very, very first thing I do is I look at the T12. I want to start my analysis of a property by looking at actuals, and then I'm gonna base the current situation and the actuals, going to kind of weigh that against my own experience. So, how does the target asking price or the whisper price or whatever they have, how does that compare to the actuals? And then based on my experience looking through those actuals, what do I see that jumps out at me that might create value? And if you look down through, and start looking at the comps and really piecing together this puzzle about, what opportunity is really here? Is the valuation based on something that's completely unrealistic? How a lot of times that you'll recognize that, some brokers are way better than others at doing a realistic model and pro forma. And that's much appreciated, right? Because you see too many where they'll say, oh, the labor is going to be whatever, $300 a door. And wait, that's crazy. Like it should be, $1,100 a door or $1,000 a door in that market. And, you'll find out that, well, it's been managed by the owner and they don't track the labor. And, but if you see that it's based on the labor is $2,000 a door and hey, we could get that to $900 realistically and still do a good job of maintaining that property, then you start to see an opportunity. So
got it.
It's a combination of running numbers and logical analysis based on experience is really what I would say it boils down to.
So on a new market, how would you determine payroll and insurance and property taxes? Because this differs by market.
Sure. So all those things are going to vary by market, although many of them will fall within a range. So you're going to say, well, in that market, it's going to tend to be higher or lower. And I will use my best judgment. But if it passes a certain level of scrutiny, that's when you want to really get an established, reputable local property manager involved who could look at it and say, okay, for this market specifically, these assumptions you've made are realistic or not realistic. Or, the same thing goes with construction costs. They could vary, and I can look at it and say, you know what, I think that new flooring should be this much. But hey, maybe in that market, flooring is much more expensive, or maybe it's a lot cheaper, right? So it's going to be within a certain range, but you just need to figure out, how you need to tweak it to get to that market.
Got it. And what do you think is since you have your own property management in your own backyard, and now you're looking at I presume you're looking at third partying your property management in this new market. Is that correct?
That's correct.
So what would you think is the most important factor to look at that third party property management company?
Well, at this point, I would say yes, we're relying on third-party property managers. We may eventually consider expanding into new markets or operations, but not doing that right now and evaluating the property managers. It's been a very interesting process. I think you need to look at the full picture. I don't think there's any one thing you can look at. For a project that we're underwriting right now, in evaluating the various property managers, of course we weigh referrals. That's always good to hear referrals. But I think one of the things that's appealing about the property manager that we ended up selecting for this project that we're pursuing is they actually specialize in the specific type of property that we're looking at. So, okay. They have a track record and experience of nearly 10,000 units that are specifically C-class properties that they've done value add and executed those successfully, and a fair percentage of those are in the specific market that we're looking at. And so there's a lot of things that just lined up. And I think if I had to pick the one thing from my interaction with this firm, because they toured a property with me as well, but I actually was very impressed with their analysis of our underwriting. So they actually went through our assumptions and they toured the property on their own before I got there and gave us their own analysis. And without us asking, they also toured the comps and gave us some feedback on that. And I was impressed. You could tell that they went out of their way to look at the right things. They looked at the types of things that I would look at, and they identified things. And based on that write-up, I just said, hey, this is a firm that's experienced. They get it. They did a thorough job. They were professional. They were responsive. And, it really checked a lot of boxes in terms of giving us an overall sense of comfort with the possibility of working with them.
Awesome. Let's go to a bit more on the value add side, right? Because you have done a lot of value add because you buy, refi, and keep it for long term, right? So what is the most valuable value add in multifamily from your experience?
I would say that the most valuable is it's different for almost every property. If I had to pick, I think that sort of the big bang, low hanging fruit tends to be I'd say, clean paint landscape, kind of like the surface stuff where, if a property is dirty and not well kept, and then you make it clean and you put a fresh coat of paint and you landscape it, it can change the entire image of a property at a fairly modest cost. And that can have a huge impact. The rent adjustment is sort of obvious. I think everybody looks at that. I think one thing that, and I guess big picture, if the landlord's way undercharging, of course, that's an obvious, big, easy one. But one thing that we've ended up doing in a number of cases that is less obvious, that people almost never talk about, is lowering rents. And in the 126 unit that I mentioned earlier that's under distress, that's the first thing that we did is we went in and by our assessment, they were trying to charge too much, which was a major factor in why the occupancy was so low. So we immediately went in and cut all the rents. And that might seem counterintuitive for a value add person, but over the last 6 months, we've raised the occupancy 25%. And one of the big reasons is we lowered the rents. And so the net change in terms of the net operating income of that property, it's skyrocketed by lowering rents. So, that also further demonstrates that it really varies. You kind of have to, it's sort of like, if you look at 5 different people and say, what change would you make in each person to improve their overall wellness? For some people, they might say, stop smoking. And some people, they might say, well, that one needs to eat better. And,
Yeah,
you can't kind of really say, well, what's the one thing overall? It's specific.
Yeah.
So
how did you decide to lower the rent? What was the data that you looked at and decided, okay, I need to reduce the rent here?
Well, that's one of the fantastic things when you've got so many properties in one market, immediately that based on your other operations, that something's off. When it's low, when it's high, when the fees don't match what's present in that market or the concessions don't match, or it becomes very simple. If you're going into a new market, you've got to study those comps and do the best you can and hopefully tour those comps and do your own homework. But, it's one of many advantages of having a concentration of properties in one area. And in addition to all the many, many operational efficiencies that you can have, is that you have that market specific knowledge there's no substitute for.
Got it. So when you decide to lower the rent, was your thought, it is a counterintuitive, even but I think it makes sense in value add, especially when you go with that kind of low occupancy. You need to do something to bring up the occupancy, because once you bring up the occupancy, you can do a lot of other things, I guess.
Exactly.
But you can't do it when the occupancy is low and you're adamant about pushing up the rent. So was your thought process, rather than I leave these units vacant, that's the biggest loss compared to giving, compared to
yes.
$25 or $30 increase, right? That doesn't make sense.
That's right. So, that's been one of the strategies that I've adhered to and has worked well is you lower the rents and lease it up, and then you make improvements as you go, and then you raise rents from there. There's nothing more expensive than vacant space.
Yeah.
And so that is, the other piece of that, which is an advantage of not syndicating, is that I have been able, in many cases, to fund many of the improvements out of cash flow. So with this particular property, we did lower the rents, but the occupancy has been brought way up. So we've just crossed a threshold where now this property is cash flowing again. And all that cash flow is going to be directed right back into making improvements, probably for the next few years at least. And so, that's a perfect example of, well, if you're going to syndicate and you need to pay investors, you really can't be investing all of your cash flow back into a property. So what do you need to do? You need to raise the money up front to pay for those improvements and not count on cash flow, so that you can achieve your investor returns and start to get them their money back.
Yeah. That's where one thing different with syndicated deal versus owning your own deal, right? Because owning
exactly,
your own deal, you don't have to raise so much money, so you can take your cash flow and just put it back, right? Whereas syndication, you're paying up front, and you may lose deals because of you're competing with somebody who has a lot of money versus somebody who's syndicating.
Yeah,
right? So
that's right.
It's very interesting. So in terms of going to more to a personal side, right? So is there a proud moment in your life, or not in your life, throughout your real estate career, that you think I will remember that moment throughout my life until the end? Can you describe that moment?
Oh, wow. There's been so many moments, but not all good.
No, the proudest moment where you think you really made a big impact on something.
I think, I never really expected this, but some of the proudest moments that I've had have been since my book came out. And I would have never guessed that would lead to that. But some of the feedback that I've gotten from readers that have shared with me that it's changed their lives, that they started into investing and have already built portfolios, and to see the direct link between the book and people, really making improvements in their lives has been extremely rewarding. So I think one of the great things is that I really went into the idea of writing the book just because I wanted to share what I've learned, the mistakes I've made and to help other people. But I never really thought that it would sell very many copies, or that people would have that kind of effect. And the fact that it did, when I get a letter or a note from somebody, it's been extremely rewarding. So, I kind of remember that. I think that's been a big impact.
Yeah, it's interesting. I mean, I get a lot of notes from my books as well, and sometimes I do. Sometimes you don't really take it seriously because for us it's just common knowledge from what we have earned. But some notes do make us think, oh, he really made an impact on someone, right? I mean, it's mind blowing on how much lives can be changed with the things that you share, in a book, right?
Right. Yeah, absolutely.
Yeah. So the second question is, why do you do what you're doing?
Well, and it's interesting. I mean, actually, in the book I share at one point, this was a few years back, I had somebody come up to me and they said, how much is enough? Like, why do you, are you so greedy? Like, why do you keep going? And I just realized that this person doesn't understand. Like, they missed the whole point, that, it's rewarding. Like, it's rewarding to take a property that's not performing, that's in distress, that's maybe even a bad thing in a community, and to turn it around and make it a better place for people to live. You help the tenants and you help the community, and to do that and start to get involved. Like I do meetups now, and I mentor people and through those in the book to help other investors. And so, I look forward to going to work every day. I enjoy it. I enjoy the challenge of finding and executing on properties that aren't achieving up to their potential, and making a better place for people to live and more profitable at the same time. So I just think it's fun. Like, I enjoy what I do.
Yeah, it's like a discovery, right? You're trying to discover this from your paper to the real stuff, I guess.
Yeah,
it's very interesting when you're especially when you're underwriter, right? Because you're assuming a lot of things.
Yeah,
right. And
absolutely.
how does that whole assumption becomes reality? It's very interesting to see the output of that and become impacting people's life, which is huge.
Absolutely.
So we really had a really good knowledge bombs from you, Brian. So can you tell our listeners and audience how to get hold of you?
Sure. Your listeners can find me on Facebook. You can find me on LinkedIn. You can find the book on Amazon.com, and or on the book website is crushingit.info. And my company's website is WashingtonStreetProperties.com. And if anybody is interested in reaching out, I'd be glad to hear from them. So.
Awesome, Brian. Thank you for coming and joining us. I think that's it. Thank you.
Thanks, James. It was an honor.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.